Randy Konik is a research analyst at Jefferies. Randy, thank you. What did you see in Lulu 3 years ago that others missed?
It was pretty simple. It's the core of the business was running out of gas. And the company, as a result, was trying to expand beyond the core, selling sweaters, sweatshirts with logos on them, Little House on the Prairie skirts that were down to your ankles. That's not Lululemon. So the company we saw was basically trying to stretch for more growth, and it didn't work. So
pun intended.
Pun intended, yes. And now it's running out of gas.
Is it fixable?
It's not fixable because when they were growing very quickly, there was no competition. It was Lululemon was the it company in the it space, especially during COVID, which accelerated the growth of athleisure. What has happened since is there's a ton of competition coming into the market. Alo and Vuori are a big problem for this company.
There's an Alo store near me. There's a Vuori. I get the catalogs. The Alo store always appears to be packed.
Yeah.
I don't know who they are. If they're public, I don't think so. What are they doing right that Lulu maybe is getting wrong? Just no ankle length skirts. I don't know.
I think Alo and Vuori they're sticking to their identity. They have a good casual offering. Their fabrications are great, and their marketing is on point. So what's really scary today is both Alo and Vuori separately have over 100 stores across the United States. That's a problem for Lulu because, again, 5 years ago, these companies, you've never even heard of them. A lot of people haven't even heard of them today, but they're...
Well, we had Athleta, right? Or Athleta.
Yeah, well, that's gets owned by the Gap. That's more irrelevant these days. But
even more irrelevant.
More irrelevant. But the problem with Lulu is actually the key is where it is relevance. It's still a relevant brand, but it's becoming less relevant to the consumer. They're losing their core customer, and that core customer is going to Alo and Vuori.
Well, let's talk about the consumer because we have the jobs number out today, and it was much weaker than expected. You guys have had, it's a Wizard of Oz theme. Lions, tigers, and bears, oh my, on the consumer. What is that, and how do we read it? And who's going to win? Because somebody's going to win.
Yeah.
Or maybe not.
Great. Thanks for bringing up the Wizard of Oz. It's our negative thesis on the consumer. We talk about lions being negative mall traffic or choppy mall traffic, tigers being rising inventory. So inventories are rising in the retail space for the first time in a number of years, and they're now exceeding sales growth, which is pretty concerning. Means
good for TJ Maxx.
Well, good for TJ Maxx, yes, but not good for most of the mall retailers that are finally bears, which are at peak margins and earnings. So if you really think about this, 2024 was the best year for retail in 20 years. So if you take that and say, hey, wait a second, mall traffic is starting to get choppy and going towards a declining trend line. If inventories are rising faster than sales growth, if comparisons are at peak, their best they've ever done, and finally, oh my, you bring in tariffs. That's going to be a problem for earnings per share. And
what happened?
Power.
The consumer finally, with $1.2 trillion in credit card debt, finally get tapped out, or is there something else here?
Well, they're definitely spending a little less. They're getting more price sensitive. You could see, you said it yourself, the job market wasn't all that great. That means lower wage growth is probably on the way. That means lower disposable income. That means we're going to have some problems ahead with spending.